David is a licensed CPA in Washington, Oregon, a beginning golfer, and a mediocre cyclist. David, it's all yours. Take it away.
Thanks, Cameron. I appreciate that very much. Thank you, everybody. It's wonderful to be here. It's kind of hard. Following up Matt's great presentation there. Now we get to talk about regulatory accounting and reimbursement issues. So it's kind of like when you go see your favorite band in concert. They always kind of lead off with like a really upbeat number, and then it's like, okay, mellow it down, slow jam time. So this is definitely slow jam time. So what we're going to talk about today is just some updates that are coming down the pipe from the standard setters in terms of Us Gaap, which is kind of where I spend most of my time practicing. I've practiced in Us Gaap since 2012, and as Cameron kind of let you know in the introduction, I'm pretty well plugged into a lot of the technical issues surrounding changes in Us Gaap. So we'll kind of take you through a lot of what that looks like, and then also touch upon some regulatory and reimbursement issues. So that's me. Not sure why I'm 8 feet tall, but I am. So what are the major changes in Us Gaap that we need to be aware of? So I spent a lot of time on the lease consulting group in my company talking about the new lease standard. So we'll spend quite a bit of time talking about the new lease standard. We'll also talk about CECL. Yes, that's how we pronounce it, CECL. So that's current expected credit losses. So that's going to be a change in accounting for primarily what we do with our self-pay patients. And then we'll get on to some reimbursement and regulation issues. And just to kind of level set on what we're going to be talking about, I just got back from a AICPA conference in Las Vegas, and every presenter used the word level set, so I'm going to start using it now. But to level set on what we're going to be talking about, I'll take you through kind of the gap changes, and then we'll talk about regulation and reimbursement. But before I do that, like I mentioned, I practice in kind of the upper area in Us Gaap, not quite as much in reimbursement. So we'll spend more of the time on the lease standard and on CECL. And I know you guys are going to be super excited about this, but I also have a slide in there about GASB 96. So I know everybody's like, ooh, I've been waiting to hear about GASB 96. And then when I was looking through the regulatory and reimbursement issues, what I try to do for every speaking engagement to the extent possible is I try to tailor my words to the audience. And so when I was looking at, what reimbursement issues are specifically facing Alaska providers and Alaskans, the two major things that we would normally talk about would be things like Medicare bad debts and reimbursement issues facing RHCs, neither of which are, when we were looking at kind of the metrics of Alaska in general, really affect Alaska quite the same way as the lower 48. There is very, very little bad debt in some of the metrics we looked at, and the RHC issues didn't really apply to a lot of the Alaska providers. So what I did is I put in what we'll spend most of the time talking about is what's kind of top of everybody's mind right now is price transparency and kind of how that's affecting providers and that sort of thing. So that's kind of what I'll take you through. But if anybody has any questions on that, they can be directed to Eric Prosser at my firm, not me. So first we'll talk about the new lease standard. So again, just to kind of take you through what these words that you're looking at mean. ASC 842, anytime you see ASC or ASU, that means FASB, which means non-governmental. Then GASB is governmental. So in the United States, we're lucky enough to have two standard setting boards for accounting and financial and accounting and reporting rules. One for non-governmental entities, which is FASB, and one for governmental entities, which is GASB. So primarily, most of my clients fit into the latter. Most of my client portfolio are governmental, but I'm well versed in both sets of standards. So just for any of you who don't speak accounting, that's all that means is non-governmental and governmental. So ASC means accounting standards codification. So what the FASB has done is they've taken all the rules that they set over time, and once they're written, they codify them by number, so they're easy to find. GASB doesn't do that; it's just 1 through 99. So just kind of to demystify that, I was at least 9 years into my accounting career before I understood that, so it was very confusing to me. So just kind of to let you know, as I take you through the presentation, we're going to talk about both sets of standards, but just that kind of tells you, if you are a provider or you deal with providers who are governmental or tribal, then you're in the GASB space. If you're private or nonprofit, non-governmental, then you're in the FASB ASE space. So, like I mentioned, we're gonna do a fairly deep dig into the new lease standard because it's super impactful to almost every hospital. Almost every hospital has leases, and if they don't, they probably have some transactions or some payment stream that's going to qualify as a lease under the new lease guidance. And so I know there's usually at HFMA there's a variety of people who attend these conferences. I imagine there's a people with diverse backgrounds that are watching online. So I also try to answer the question like, why do we care? Like maybe you work in billing or maybe you work in rev cycle, and you're not really involved in putting together or preparing the financials or working with the external auditors. So why should you care about the lease standard? The lease standard really hits a lot of pain points in a hospital and how costs are allocated across departments and that sort of thing. So while it may not affect you directly, it may be the case that the finance team, once they kind of get caught up with the lease standard, they might come back to you and say, hey, we need these reports, or we need you to drill down this way, or we need to be able to allocate costs this way. And depending on your role in the organization, it might be good to at least have a background in what the standard says. So Topic 842 defines a lease as a contract or part of a contract that conveys the control of property, plant, or equipment for a period of time in exchange for consideration. I'm not sure why the consideration wound up on the other side of the screen there, but the identifiable aspect must be physically distinct, and the supplier can't have substantive substitution rights. So that means that if you're leasing a piece of equipment, the supplier can't swap it out without you knowing about it. You have to have pretty much full-on control of that asset. So that brings us to the control element. You have to have the right to obtain substantially all economic benefits. So you're using the machine or the piece of equipment to provide cash flows or provide benefit for your organization, and you have the right to direct the use of that asset, not the supplier. Spans a period of time, so the contract has to have a term. Yeah, question?
So you say no supplier substitution rights. What if you set up a lease for a piece of equipment that can be upgraded over time? Is that if you as the... You have a good question. So there are some... There are some leases. It's a good question. There are some leases where you sign a 10-year lease, say, for a hospital transport bed, and so that the supplier, over 5 years, maybe they could replace it with a new version on an operating lease. Is that still subject to this rule, or are those kind of leases different? Yeah, that would not carve you out of the definition of a lease. What a substantive substitution right on the side of the supplier would mean is say you're leasing like a dumpster, and they come in and they empty it and they swap out a blue dumpster for a red dumpster, and you don't care because you don't care about the color of the dumpster. But in the situation where there's maybe some upgrade clauses or something, what you have there is maybe some lease modifications taking place over the life of the lease. So you still have an identifiable asset. While you have that asset until such time that it's upgraded at least, you have the right to obtain substantially all of the economic benefits of that asset for a period of time. So you're still in the definition of a lease. You're just, as that asset gets upgraded, then you're into lease modification territory, which I haven't actually timed this presentation, but I did cut some stuff out of it, and I don't think we're going to get to lease modifications today. That gets way off into, nerdiness that I didn't think I would have time for. But yeah, you'd still be in ASC 842 or GASB 87 territory there. Because as you'll see, the definition of a lease for both sets of standards is really similar with some key differences that we'll go over. And then the one thing I didn't talk about yet is consideration, so that's payment. Could be monetary, could be non-monetary. In most cases, it's going to be monetary. You're going to be paying for this thing. So Changes and similarities between 840 and 842. So 840 is the old lease standard, 842 is the new lease standard. So sometimes we'll say legacy GAAP and then new GAAP, or the old lease standard, new lease standard. That's just to kind of define what we're talking about there. So this is really, if you're preparing financial statements now, this is what you were doing, which versus what you're going to start doing for year end starting after 12/31/22. Did we have a question? Okay. So we have two really similar definitions. So not much substantive difference between the definitions. Both have a contract agreement. Both have an identifying asset, the element of a control, the element of time, consideration. So the definitions are really the same. So chances are, if you had a lease under Topic 840, you're going to have a lease under Topic 842. Also, another kind of weird thing in the GAAP, topic and ASC are kind of interchangeable as well. So I kind of throw those in there. So like I said, the definition is basically the same. So if you're looking at your general ledger right now, you have operating leases under 840. There's still going to be operating leases under 842. So why do we care? This is kind of the whole punchline. If you forget nothing about our little chat about leases today, remember this. Under the legacy GAAP, you had two different lease models, operating leases and capital leases. Operating leases are off balance sheet, which means those you got the right to control an asset, but you didn't recognize an asset on your balance sheet. You didn't recognize a liability for the payment stream that you're paying for that asset. You just recognized rent expense on your income statement. So there was no balance sheet impact at all. And a lot of companies really love this. Airlines could keep huge amounts of liabilities off their books this way. But the FASB felt in order to improve the usability of your financial statements for the users of the financial statements, if you've committed to a future payment stream to control an asset, then it's worthwhile to show a liability for those future payments and an asset for the control of that asset. So the big punchline of this entire section of this presentation is that now, starting in 12/31/2022, is all leases will have at least some balance sheet impact. So your operating leases will now show up as a right of use asset and a lease liability instead of just rent payments. So we'll kind of take a look at what that looks like. So the impact on operating leases is under 840. Like I said, these were just expensed as incurred. You'd pay a rent expense, cash would go out the door, you'd have no asset, no liability. And so now you're going to have all these liabilities and all these assets that you didn't have before. So we're going to talk a little bit about classification. You guys heard me use the words operating and capital leases. Those are going away, and they're being replaced. They're being replaced with operating leases. Will still be operating leases, but not in the sense that we're used to looking at them, where they're off balance sheet. Now, operating leases are going to be capitalized, and then you have capital leases, which won't be called capital leases anymore because all leases will be capitalized. They'll be called finance leases. So under the old lease standard, capital leases, which are, remember, now called finance leases under the new GAAP, there was 4, maybe 5 elements that would determine whether or not you had a capital or an operating lease. One was a transfer of ownership. So if the lease transferred ownership from the lessor to you at the end of the lease, then it was capital, end of story. It had a bargain purchase option. So sometimes we see in our lease agreements that at the end of the lease, you have the right to buy the asset for like $1 or $10, some really small, something that you'd be silly not to exercise. If it has a bargain purchase option, then you're basically just buying it, then it's a capital lease. If the lease spans a majority of the useful life, 75% test, then you'd have a capital lease, and then present value of the discounted present value of the future lease payments were 90%. So the only thing that's really changing here is under ASC 842 is we still have the transfer of ownership criterion. We still have the bargain purchase option criterion that determine operating versus finance lease categorization. Now, GAAP just says majority of the useful life, so the 75% test is kind of going away. There's no longer a bright line. And the present value of the minimum lease payments is substantially all, so the 90%. So a couple of those bright lines are going away, but what we're seeing a lot in practice and with our clients is they've already codified the 75% test and the 90% test in our clients' accounting policies, and so they're just keeping that, and they're saying as a matter of policy, we interpret majority to be 75%. We interpret present value of the future minimum lease payments substantially all. We translate substantially all to be 90%. Then it just saves them. It's just a little bit kind of like a practical expedient in a way. They don't have to go back and kind of rewrite their existing policies, and they don't have to update their accounting. So just kind of an easy thing for them to do since they didn't really change that way. So the lease, now that we talked about the lease definition and we talked about the categorization of a lease, how do we measure the lease liability? So you have a future payment stream. What we're going to do is we're going to discount that to present value using a discount rate. And once we know what the discount rate is, once we know what the present value of the future payments are, that's basically our lease liability in a nutshell. So the problem you run into is especially building leases. Like, how many of you are familiar with building leases or have building leases? Any of them have interest rates in there? I've never seen an office space or an apartment lease with interest rates. So what GAAP says is, instead of trying to figure out what your incremental borrowing rate is, which can be tricky to do, you can use a risk-free rate, which in most cases is going to be a U.S. Treasuries rate for a similar termed agreement. So if you have like a 10-year building lease, you can look at like a 10-year U.S. Treasuries rate and say, as a matter of accounting policy, that's the rate we're going to use to discount this to present value. So that's so you take those future payment streams, you discount them to present value because you're receiving the present service capacity of that asset. You're being able to use that asset today, but you're getting the benefit to pay over time. So you discount that using the appropriate discount rate, either what's in the agreement or the risk-free rate. And then when the payments come over time, then some of it goes to interest, and then some of it goes to reduce the liability. So that's kind of the first step, is you determine what the lease liability is, and then you determine what the right of use asset is after you determine what the liability is. So the liability accounting really drives the asset accounting. So you start the calculation of the right of use asset starts with the lease liability plus or minus a couple other things, and then you wind up with your with what you have for your right of use asset. So initial direct costs, prepaid lease payments minus any lease incentives. Those three, I can point. These three circles here aren't going to be present in every lease. So in a lot of cases, your lease liability is going to equal exactly your right of use asset. And this isn't a trivial point for a lot of you who prepare financial statements or work in my world of analyzing financial statements, because I think a lot of the heartburn with any new accounting standard is, oh boy, am I going to have to restate prior years? How is this going to affect equity? Am I going to have to go back and do a prior period adjustment? In most cases, no, because you're recognizing, we all know equity is assets minus liabilities. So in this case, you're going to be adding liabilities fundamentally at the same rate you're adding assets. So you're just kind of grossing up both sides of the balance sheet. Both sides of the balance sheet are growing at the same rate, so your equity is going to stay the same. So now we've measured the asset and the liability. We're all ASC 842 experts now. We're going to talk about what some of the key differences are between 842 and GASB 87. So again, just in case you missed it at the top of the presentation, ASC 842 comes to us from the Financial Accounting Standards Boards, the FASB, who promulgate Us Gaap for non-governmental entities and then for governmental entities. So cities, states, townships, tribes, counties, school districts, hospital districts, GASB. So one of the biggest differences is the effective date. If you're a unit of government with a June 30th of 2022 year end, you're already in GASB 87 territory. So your June 30th, 2022 audited financial statements will have to have the tenets of GASB 87 built into it. So that's important to note. GASB or FASB, you have another 6 months. So it's fiscal years beginning after 12/15/2021. Just kind of important to note, both these standards were supposed to go into effect a lot sooner, but because of the global pandemic, both standard-setting bodies came out with authoritative guidance that pushed out the effective dates to give some administrative relief to entities that were kind of dealing with the pandemic and not having to rehash their financial statements. But they've told us there will be no more extensions. They're going to be effective now. And I get a lot of questions about the effective date for ASC 842 because I have a lot of clients who have interim financial statements that they issue internally, or maybe they have like a banker or somebody who needs to look at them. It actually says in the guidance, it's for fiscal periods ending after 12/15/2021, and then interim periods basically starting a year after that. So basically your year-end financial statements for 12/31/2022 is the first year that ASC 842 would have to be adopted. It doesn't apply to interim reporting periods until 2022. So one big difference is the reporting model. We talked a little bit about how the FASB retained the two lease reporting model where you have operating leases and finance leases, which replaces the old model of operating and capital leases. So there's a little bit of difference in the back end accounting and how the costs flow through the income statement, but in both types of leases get capitalized and put on your balance sheet. GASB 87, all leases are just simply leases. So there's no longer an operating lease option in GASB 87. If it meets the definition of a lease under GASB's definition, it's just going to be simply a lease. One major exception, I think I have a slide on this a little bit down the road, is finance purchases are not leases. So when we were looking at the criteria for what determines an operating versus a finance lease, which used to be called a capital lease under ASC 842, the number one criterion was a transfer of ownership. So if you're a FASB reporter and your lease transfers ownership from the lessor to you stop right there. You don't analyze the 75% test, you don't analyze the 90% test. You have a capital lease. GASB says if it transfers ownership, then it's a finance purchase. It doesn't meet the definition of GASB 87. And then you're into GASB 88 debt territory, accounting for it as a finance purchase. So basically, you account for it just as if you're taking out a car loan to buy a car, as opposed to leasing a car. And so if anybody is looking to become an expert on GASB 88, I'll leave some cards. You can call me up. I would love to chat you up about that. It's just a little bit outside of the scope of today's presentation. The transition guidance. We talked a little bit about the transition dates. So ASC. Now we're going to talk about some of the guidance around what happens in the year you transition from the old GAAP, which for FASB was topic 840, and GASB, which was GASB number 62. So FASB over here on the left, your guys' left, I guess, they give us a couple of different options. One is called the modified retrospective approach, which is basically if you have a 2-column set of financial statements with 2022 and 2021 comparative financial statements, both columns are presented the same. You adjust both columns to conform with 842. So both 2022 and the prior year would be adjusted to be updated for topic 842. But the FASB realizes there's a lot of really small companies, there's a lot of really small providers that have to comply with this, and maybe it's easier for them just to do it in the year of implementation only, and then there forward. So they have a modified retrospective effective date method, where even if you have comparative financial statements where you have 2022 and then you have 2021, you would update 2022 to have lease liabilities to conform with topic 842. But then the prior periods would be presented according to 840. So there's some benefits and some advantages to financial statement preparers in both ways. the option 2 is easier because you don't have to reopen closed periods and kind of figure out what happened in the past. But your notes to the financial statements might be a little bit longer because you have to have kind of one set of notes for 2021 and AS 840, and then another set of notes for 842. GASB 87 just says full retrospective. All prior period financial statements need to be restated. So if you have a governmental hospital, government health hospital district, something like that, that traditionally issues 2-column financial statements, you have to take the whole GASB 87 guidance through both years. You just don't have the option. So some clients, I used to audit Washington State University. There was a similar thing with some pension standards a few years ago. They elected on the financial statements that I was working on just to go down to one column, so the prior year dropped off, so they didn't have to reopen a prior period and figure out their pension liabilities for there. So I expect some of our clients who as user of the financial statements wouldn't be affected by that missing information, may just do that to just drop down to 1-year financial statements. The discount rate, we talked a little bit under ASC 842. You're allowed to use the risk-free rate as a practical expedient, which in most cases is going to be a U.S. Treasuries rate. AS 842, GASB concluded that the risk-free rate is not allowed. The board deliberated on this, and the board decided that leases are not risk-free transactions, so it wouldn't be appropriate to use a risk-free rate. So then you're into the territory of having to calculate your entity's incremental borrowing rate, which is theoretically the rate that you would be able to borrow the same kind of stream of money for the same length of time. So what that usually looks like is getting in touch with your banker, whoever you have a banking relationship with, and figuring out what the interest rates are doing today for similar amount of money for similar period of time. Related party leases. So in practice we see these a lot, and these are way more common than you think. ASC 842 is kind of a form over substance. It says if the agreement has terms, those terms are what are going to govern how the accounting. So what this means is if you're leasing an asset from a related party at substantially lower than market, you don't have to write up like an in-kind revenue amount for the amount of contributed capital that you're getting from the related party. GASB 87 is exactly the opposite. It's a substance over form standard, which means that you account for, no matter what the agreement says, you have to figure out kind of what the market rate is and account for it as if it was an arm's length transaction. So for example, if you're a hospital who's leasing an apartment building from your foundation, and you're leasing it for less money because it's beneficial, the foundation supports you, they're not going to price gouge you on the price of this apartment. If you're governmental, you're going to record the lease based on the market price of that apartment building, and then the difference is going to hit some sort of like in-kind revenue, like a non-cash revenue item. Whereas if you're a non-governmental reporter under FASB, you're just going to record it at whatever the terms of the agreement are. And this has actually been a little bit of a hot topic based on at the FASB, because what we see a lot of is these short-term leases that are like month to month that are related party. And a big question we've had is, do you have to analyze what's written down that it's a month-to-month agreement, or do you have to kind of break down that fiction and say, okay, they're going to stay in this lease for 10 years. This is really a 10-year lease. It's really not just written down. So that's kind of been, I'll kind of keep you guys up to date on where we land on that. But that was a hot topic that kind of came up last week at the AICPA conference in Vegas. I asked one set of FASB board members that question during one of these sessions as an attendee, and one of my colleagues asked another set of FASB board members the same thing at another session, and we got two different answers. So never a dull moment in public accounting. So again, we already kind of talked about this a little bit, the transfer of ownership. A lease that does transfer ownership puts you into finance lease territory under 842. Under GASB 87, it's carved out of the lease agreement. Now, a lot of people, this transfer of ownership is a pretty high bar to meet. It has to say that in the agreement that it's transferring ownership. If you have a bargain purchase option, that doesn't constitute transfer of ownership. Even if it's $1, even if it's 50 cents, even if it's a dime, it has to be a complete transfer of ownership. So bargain purchase option, lease. Non-bargain purchase option, the ownership transfers you at the end of the lease. Not a lease. GASB 88 territory. Unless you're a FASB reporter, then you're in finance lease territory. Embedded leases, so these are another one of those things that when this came out, we were kind of, in my office, we're like, this is nothing we're ever going to see. But embedded leases, this is something we really have to watch out for as preparers of financial statements, because these are lease agreements that are embedded in like a purchase arrangement. And we saw a lot of these when there was a lot of testing for COVID-19 going around, where organizations would solicit hospitals to say, hey, we want you to enter into a 3-year purchase agreement to buy test kits from us. And what did providers say? They said, no way. We don't know when this pandemic is going to end. Why would we lock in pricing for you for 3 years? We'd have to be insane to do so. And so they were trying to sweeten the deal by saying, okay, these test kits really work really well with our analyzers, so we'll give you the use of the analyzer free. We'll even send somebody to your site to set it up. You'll have complete use of the analyzer, completely free. Now what does this sound more like? This sounds like a penny cell phone deals, where you're really just financing the cell phone through, I'm dating myself, I just realized. You're really just financing the cell phone through the service agreement, right? Same deal. You're really just financing the purchase of the analyzer through purchasing these test kits, right? So now you have an embedded lease, where you have a lease that's embedded in a purchase contract. So what you have to do there is you have to separate out and figure out, okay, what's the fair value of that machine? That gets into lease accounting territory, and then the test kits they get expensed through supplies. So again, FASB, being the nicer of the two boards, said that you can, as a matter of accounting policy election, if you make the election and just say, hey, we're not going to worry about lease and non-lease components, if an agreement contains a lease, the whole thing's just going to be a lease. And this makes accounting a lot easier, because when the bill comes in, your AP staff have a lot easier time processing it. There's just less legwork. So you have the two options under FASB. You can either elect that the whole analyzer test kits, the whole thing's just a lease, or you can separate out the fair value of that machine and attribute what payments for each test kit are attributable to the cost of the machine, and which ones you're actually just buying the test kits. GASB says you basically just have to do the legwork and separate out lease and non-lease components and account for them. The components of the agreement that fall under the lease guidance are GASB 87. The ones that aren't are just going to be straight up expenses. So that's another kind of practical expedient that's not allowed. Recard Disclosures, it's the really big takeaway here is just that the disclosures in your financial statements, the notes to your financial statements, are going to look a little different under the two sets of standards. And for those of you who are familiar with preparing financial statements, you can see they're very similar to the differences in the existing debt standards. So I won't take you through those in detail, because I want to make sure. Gosh, we must have a different version of like PowerPoint on this machine than it's on my machine, because the spacing's kind of wacky. Any rate, not a big deal. I want to leave myself enough time to talk about GASB 96, because I know you've all been waiting with bated breath about this one, but it does tie into what we've been talking about this whole time, and CECL and price transparency. But really, we spent most of the time talking about the lease standard for good reason. There's a lot of complexity to it. It touches a lot of different areas of the organization, between purchasing, requisition, accounting, finance, and that sort of thing. And there's a lot to tackle. And we could spend now until next weekend talking about the lease standard. There's just that much to it as that. But it does dovetail nicely into GASB 96, which is accounting for EHR and EMR payments. Now, this is a GASB standard, so this is governmental only. FASB hasn't taken this up yet. So for private and non-profit, non-governmental providers, this isn't a thing yet, but for governmental providers, it is. So this deals with subscription-based information technology arrangements. So this is like your EHR, EMR payments. So I'll pick on Cerner. Like, anybody here familiar with Cerner, use Cerner? Can spell Cerner. If you're paying Cerner to use their software on a subscription basis, basically you're going to account for those payments similar to lease accounting. So if you actually go in and read 96, you'll see there's a lot of similarities between this and the lease standard. So again, what it's doing is it's taking the spirit of taking those future required payments that you're committed to pay over time and then forcing you to capitalize those as a liability. So you can show the users of your financial statements in what way, your hospital's been encumbered by those payments because you've entered into an agreement. In the past, these have typically been expensed and not had any sort of balance sheet impact. Some providers have looked at these payments and concluded that they meet the definition of a lease under GASB 62, but since these typically have to do with software, they've specifically been carved out of GASB 87, so they're not going to fit they don't fit into leased guidance anymore. So now there's new guidance over these payments. I just thought there's some complexity to this one. There's a 3-tiered approach to the different types of payments that you're going to incur. There's a 3-tiered approach depending on what phase of the implementation you're in. But since these affect so many different types of hospitals and so many hospitals, I thought it would be important to at least bring it up and get some visibility on it because this is coming down the pipe. Not quite as urgent as the lease standard because this won't be in effect until 12/31 of 2023. But I have a lot of hospitals who have these type of payments. They've accounted for them under the old lease guidance. Now they're carved out of the old lease guidance. They're like, well, crud. Now I have to de-recognize the liabilities that I had, which is no big deal, except it's going to, make my financial statements less comparable. The users of my financial statements are going to have questions here. And so what I have a lot of clients doing is adopting GASB 87 for 12/31/22, which they have to do, and then early adopting this one so that they don't have to change their accounting for their I'll pick on Cerner again, for their Cerner payments, so that they don't have like a down year where they de-recognize a bunch of liabilities and assets and then re-recognize them in the next year. So just kind of not a requirement, but just kind of something that they've elected to do because it's expedient to do so and the guidance allows them to. So again, another really, really impactful piece of guidance from the Governmental Accounting Standards Board that's going to affect a lot of governmental hospitals. Not going to spend a ton of time talking about CECL, but this only affects non-governmental facilities. So the Governmental Accounting Standards Board hasn't taken up CECL. So CECL stands for Current Expected Credit Losses. So what these are is kind of to drill down to healthcare, because this affects banks, it affects construction companies, it affects retailers, but specifically with hospitals, what we're really talking about when we talk about current expected credit losses is we're talking about our self-pay portfolio. Because we all have agreements with third-party payers, Medicare, Medicaid, Blue Cross Blue Shield, and a number of other payers where those payers pay us a discounted rate. Those aren't credit losses, those are contractual adjustments. So that isn't a matter of they won't pay and so we have a loss. That's a matter of we've adjusted based on our contract with that payer. And in most of those cases, there's very little bad debt. We may not be paid super regularly or may not be paid as frequently as we like by those payers. We may not even be paid the rate we really want by those payers, but it isn't a credit loss. We haven't provided a service and then not got paid for it. We're just not getting paid what our charge master says we're going to get paid. We're getting paid the contract rate. So that's outside of this guidance. What CECL is going to apply to is our self-pay patients where we've provided a service. The patient is, for a multitude of reasons or any number of reasons, is on the hook for the payment, and then they can't pay, and now we have a credit loss. So this just kind of forces us to recognize an allowance for the lifetime of expected losses, not just what the loss is at year end. So the legacy gap, the old rules, which I don't have the accounting standards codification number. The new one is ASC 326. I don't know what the old one was. But under the old gap, under the incurred loss model, impairment is recognized for credit losses that have been incurred as of the reporting date. So for 12/31/22, you'd have your self-pay losses as of that date. The new gap forces us to look and see what future events are out there that may affect credit losses. So it kind of forces management to say, is a recession looming? Do 90% of our patients work at the sawmill that we know wasn't closed down at year end, but maybe, and isn't going to be closed down this year, but probably will be closed down 2 years from now? Is that going to affect our self-pay portfolio? Absolutely it is, because that's going to affect a lot of your patients' ability to pay. So I think for me, when I was first learning about CECL, this slide right here is probably the most impactful in helping me understand and kind of conceptualize it. Is under the old GAAP, this is how we accounted for credit losses, was current conditions plus historical loss experience. So we look at what our self-pay losses used to be and what they are now. Now we look at what our self-pay losses used to be, what they are now, and then what we expect for them to be in the future. So there's kind of stealing my own thunder here and kind of getting ahead of myself, but I think what we expect as financial statement auditors, financial statement preparers, financial statement users, is we don't expect huge seismic shifts in our self-pay write-offs or our self-pay losses as a result of CECL. But what we're going to have to do is we're going to have to go back to our accounting policies and maybe update our policies so that they can form a CECL. So we have a policy that says, yeah, we're considering expected future losses. So there's a lot of work on the back end that you maybe won't see show up on the financial statements, the balance sheet and income statement, but you'll definitely see it on the back end in your accounting policies where a lot of the rubber meets the road and how these are accounted for. So real quick, the guidance gives us 6 different alternatives for our methodologies for adapting to CECL. Ranging from toward the top here, we have these organized. These are the simpler ones, and these are the more precise ones. And I'm not going to get into how these all work, except to say that most of your hospitals are already doing this. You just haven't maybe called it this. So it's just a matter of aligning the new topical guidance with what you're already doing, so you can tell your auditors and tell the external world, yeah, we've incorporated the tenets of ASC 326 into our accounting model. So feedback that the FASB got from non-banks, this is, as you guys can imagine, for banks, this is pretty impactful, right? Because that's their business of making loans and accounting for losses of credit losses is a big part of their business. Non-banks that have already adopted CECL, they did not see a huge change to their allowance. This is kind of what I was saying earlier, is not, we don't expect huge material seismic shifts in your allowance, but again, it's something you're gonna have to be aware of and bake into your accounting policies. So in the last 15 minutes or here before or so, man, I timed that well. I didn't time this speech. I was kind of sweating that. I'm like, oh, I should have done that. We're going to talk about price transparency, which I'm not quite as familiar with this as I am the GAAP rules, but I know enough to be dangerous. So I'll take you through it because I know this is an area of heartburn for for everybody. So kind of the history. 2019, CMS finalized and expanded its interpretation of 2718, which basically said that you're going to have to publish a price list. You're going to have to be more transparent in how you price your services. So the AHA, which is a body that represents a lot of people that we work with, from a not regulatory, but what's it called? When you advocacy point of view, that's right. So the AHA challenged this regulation, and they said, this isn't fair. The costs of adapting to this outweigh the benefits. And what's really the point of having shoppable services and whatnot when, if I live in Spokane, Washington, if I break my leg and I'm outside of Holy Family, I'm going to go to Holy Family so I can get it fixed. I'm not going to drive across town to the Sacred Heart to save $50 on the procedure. And just because of how consumer behavior is in healthcare, that was kind of AHA's argument, is consumer behavior in healthcare is fundamentally different than consumer behavior in other sectors of the marketplace. So does this really even make sense? And then in 2020, a federal judge ruled against the AHA in its lawsuit that was attempting to block the ruling. So now we're in this world where price transparency is a thing, whether we like it or not. So what we're seeing now is some of our clients and people kind of in our sphere of influence at Wifley are being penalized for not complying with the price transparency rules. The current penalty is $300 per day maximum per hospital. And for a lot of our community hospitals, that's pretty impactful. For a lot of big systems, it's a drop in the bucket. So, right, wrong, or indifferent, we've been hearing, not necessarily like in public forums, but just kind of hallway conversations and privately. Management at some hospitals are just kind of making the business decision. Hey, look, this rule is really expensive to comply with. It's cheaper for us to just pay the $300 a day, like by a long shot. And so, again, might not be the best thing from the compliance point of view. And if there's any compliance officers in the room or online, you're probably cringing right now, but that is happening. And CMS realizes that. So CMS has a proposed penalty of scaling the penalty to tie it to the number of beds. So the larger facility you have, the more impactful it'll be to kind of, so that the larger systems of the world can't just fly under the radar by paying, what is to them a super trivial penalty. So I think the big takeaway here is this isn't going anywhere. CMS isn't backing off on this. This is something that's here to stay. And evidently, they're willing to ratchet up the penalties to kind of get hospitals to comply. So what now? 2 data sets are required. Yes.
Could you go back to the first slide?
Yep.
Thank you. I just want to make sure that, is this a typo on $10 per day per bed on the second bullet point? Is it supposed to be something else?
I think it's supposed to be 100.
100.
But I can
Maybe
find out and get back to you.
1,000, just to look at the progression.
Yeah.
Okay.
Yeah, $10 a day would be kind of self-defeating. You're right.
Okay, thank you.
You're welcome. I'm sorry. So when we're talking about, I actually borrowed that particular slide from a similar presentation that we did for an organization in South Carolina. And so now I'm going to have to talk to that presenter and say, hey, get a hold of your contact in South Carolina. Just make sure they know that. So you have to prepare 2 different data sets. So there's the all service data set and then the shoppable data service set. So the all data set is the all service data set includes gross charges for what the walk-in rate would be. And then the shoppable service data set is a list of 300 shoppable services. And that's a mixture of 70 required ones, and then the rest of them can be filled out by some of the more popular ones at your facility. So the shoppable service data set, they require 300 shoppable services at least. Has to have 7 commonly shoppable services listed. So the regulation, the actual rule 2718 has the 70 listed in there. So your organization either has to have the 70 or you have to have state, we don't do this service at our hospital. We have one really small hospital in California that's basically just an emergency room where people go, and if they need anything done at all beyond what they can do just for stabilization, they get sent out. So obviously theirs is going to be really simple because they provide very few services. But if you're Providence or you're Alaska Regional, you're going to hit that 70 and then have no problem getting to the 300. So how do you select these? The 70 is pretty easy because that's in the regulation. And then the remaining 300, you have some flexibility on not every hospital is going to have the remaining 230 services to get to the 300 total. So there is some flexibility on what you can report there. You start with the top inpatient cases, and you look at what the required DRGs are and that sort of thing is. You might need to get with your billing people and your claims people to determine which services you need to include, because the example we have here, DRG 460, could be 3 different procedures. So you really need to drill down at the claims level to figure out which shoppable services to put in there, based on the more popular ones at your hospital. One thing that we wanted to raise your attention on is to keep the number of services bundles to a minimum. because for each bundle, as you saw a few slides ago here, this is what a service bundle for, we have a couple here, as an example, colonoscopy, office visit, and then vaginal delivery. As you can see, the more bundled services you have, the more complex they are to report on, because you have more primary service and ancillary services to report on. So if your shoppable services include a lot of those bundles, then it's going to increase the complexity of your reporting. And then when you're analyzing your claims data to determine which are the most popular services at your facility, you kind of have to do a sanity check and eliminate the unbelievable claims that may have been gotten billed incorrectly, things that have been billed under the wrong DRG or what have you. And this is where your billing and coding experts kind of really come in for that sort of thing. So one thing to kind of leave you with is, where's your hospital at in the process? So we've seen entities kind of pop up out of nowhere that kind of bill themselves as price transparency experts that are willing to help with this. But then we've had clients of ours hire them on to create a compliance roadmap for price transparency. But then when they get to the end of this and that we figure out what the deliverables are, they'll give them a file that isn't machine readable, which it's in the regulation that these data sets have to be machine readable. They don't have to be downloadable, but they at least have to be machine readable. And they're not even getting that. So what that's telling us is a lot of companies out there are kind of trying to just take advantage of a lot of the panic in trying to comply with this. So it's just important to know that the amount of detail in the work to capture and analyze this data is pretty significant. So that's all I prepared for you today. I definitely have a few minutes for questions before our hour together is up. But I really appreciate you sticking with me through, especially after the last presenter, to talk about regulation and accounting, which is stuff that gets me excited, but I understand I'm not everybody. But yeah, are there any questions? Any questions online?
Question, I have one here. As far as real basic, I think, maybe you already said it, is it still based on just your gross, or is it based on net? Is there some kind of average of payers?
For the price transparency?
Yeah.
It's based on your gross charges.
So it's just still gross?
Yeah.
Okay.
Yeah. And that's not, I work with some people who are some absolute, Jedis with price transparency. I'm not one of them. I deal with more, my job is to audit financial statements, so I'm super plugged into kind of the more GAAP rules and stuff. But in a lot of ways, just like with anything else, the regulations are a lot of times more, when I get to talk to some of my audit clients, they're like, yeah, accounting, we get it, but this is what's really getting me heartburn. And that's one answer we're getting right now is the price transparency is really giving them heartburn.
If that's it, hey, round of applause for David with Withly.